On Canberra Live with Leon Delaney. Money Matters with Luke Smith from Envision Financial Services.
No, we're here to talk finance
Yes.
and Money Matters with Luke Smith from Envision Financial. And today's topic, how much risk should I be carrying in my super fund?
Yes.
So this is an interesting topic, isn't it? Because
It
most
is.
of us assume that the people that are managing our super funds are pretty smart people.
Yep.
And they would be good at managing risk.
Look, and I would agree with that comment because they are. But I think there's a huge gap between what you think you're carrying and what you're carrying. And that's really what we're going to sort of work our way through today for some context, because I find there's a general assumption, and I had that this week, and I sort of written today's show off a conversation I had with a client on Wednesday, that he wanted to do something and his wife said, oh, well, I don't want to do that. That's risky. And it was a great indication to me that people hear the word super and associate it with risk. And what I mean by that is this. If I have an industry fund, a personal super fund, or a self-managed super fund, they are just vehicles to hold assets. Okay? What you do inside that vehicle then determines the level of risk that you carry. Another analogy I use regularly is if you and I have the same car and we drive down the Barton Highway and the speed limit's 100 and I do 100 and you do 160, your car could be perceived as more dangerous. So it's the way you drive your car, not the model of the car, that determines the risk.
Yeah.
So if we separate super and risk, we then have to say, well, what determines the level of risk that I maintain? And we come back to that wonderful label of balanced. And now, nobody knows what that means. Now, if you and I were on a seesaw and it was level, that's balanced. That for me is 50% growth, 50% defensive. But we all know that when an industry fund is saying we have the best balanced fund, what they're not saying is we drive the car at 160 kilometres in a 100 zone. And the other super fund over here says, well, I only drive at 110. So it's not fair to assume that the label of balanced means the same thing in different ways. So we need to look at the asset allocation and say, well, what is my exposure to growth assets? And the best way to do this is to look at the fund you're in, pick the option that you're in on the website, and then you'll see a colourful pizza. And we'll have all the different sections, which is the diversification of the way that your option is invested. And for me, a balanced option is anything from 50 to 60% in growth assets. Now, what's a growth asset? Australian shares, international, property and infrastructure. They are generally the three sectors that would fall in the growth side. And then on that piece of pizza with all the different percentages on it, you'll see things like credit, fixed interest, cash. That falls on the defensive side. So for me, most things get run at 70% growth, 30% defensive. Now, that is very close to what an industry fund would call balanced in most instances. I think Australian super might be 75, 76% growth assets, 24% defensive. For me, that's a growth portfolio. So if somebody comes in and says, well, you know, I'm very aggressive, you might run 85% in growth assets because you understand that. I want to be very conservative. You might run 50% in growth and 50% in defensive. And then when you're looking at your fund, you need to then think about, well, how else can I manage the level of risk that I have? You can ensure you don't have big allocations to individual holdings, right? CBA is a great example, okay? Trading at a ridiculous price. Everybody's loved it for forever, like most bank stocks. But if you've got 25% of your portfolio in one investment and something bad happens, you have an increased likelihood that the value will fall if that stock comes under pressure. So I always sort of say to people, don't have too much of even a good thing just in case. So diversify the investments that you hold. If you're in pension phase, to try and mitigate the impact of risk, what you can do is run your living costs plus another 6 months in cash. So you might have $1 million in super between you and your spouse, and you might need $100,000 a year to live. Keep $150,000 in the bank account of your super fund. Why would you do that? Because you know for the next 12 to 18 months, no matter what happens in a market, good, bad or indifferent, COVID, not COVID, GFC, no GFC, tech bubble, no tech bubble, tariff, no tariff. You've got 18 months of your living money market exempt, risk-free, so that you can live the way you want to live. And that gives you 12 to 18 months to recover from volatility. We saw that in April. Talk about tariff, market came down, market came back, market's now run really strongly and is at record levels. So if you hold a year or 18 months of cash in your super fund, you've taken away market risk. And I find that gives people a huge amount of comfort. And that just comes down to how you manage the assets in the super fund. Another way to try and then make sure that you've got what you need is control the income from your investments. So be in a super fund that lets you collect dividends from your assets. Because if you can generate a 4% income and you're taking out 5% to live, you don't really care what the value of the stock is, because a lot of what you need to fund your pension is through dividends. Just like you'd buy an investment property and rent it. How many people do you know go, oh, I'll buy this investment property, but I want to see all the value come in the market value of the house? People go, well, but I need the rent to pay the agent, I need the rent to pay the rates, I need the rent to pay the insurance. Super fund's the same. We need to be in a good super fund that allows you to control the income, the tax and the franking credits, because at the end of the day, in a pension phase, franking credits are just cash that comes back to you from the ATO. So if you can't control that and you're in pension phase, I think you're limiting your ability to have some peace of mind and have the key controls that I find most retirees are after. Luke, give me a good, strong income stream. Luke, get me some growth to offset inflation. Luke, maximise the use of franking credits, whoever Frank is and whoever he's crediting. All right? That's what I generally get. So if you're in an industry fund, again, we're not bashing industry funds, but you've got none of those controls. And that's why I say a mini will never pull a horse float. That doesn't mean we don't like minis. I've got 2 little girls, and when they've got licenses, I'd buy them a mini tomorrow. But it's not going to pull a 3-ton horse float. We need a super fund that allows us to control our assets and our underlying risk profile so that we have peace of mind in retirement to live the way we want to live.
The right vehicle for the right destination.
100%. And again, it's not about is it good or bad. Tradies drive utes for a reason, right? Because you can't get all your tools in the boot of a mini. So I'm not here saying, oh, industry funds they don't serve a purpose. Anything serves a purpose to a point. But I find the interest and concerns of people when they retire change significantly from the vehicle they use to accumulate their assets in. Because now they are very aware of their risk profile. They're very aware of the allocation to assets. They're very aware of then diversifying each asset class. And what I mean by that is we might have 30% in Australian shares. Now, within that 30%, or let's say 300,000 in a million, you then may have 10 to 15 different assets. You might have some blue chip shares. You might have some diversified ETFs. You might have a specialised Australian equity fund that pays 7% income. And that's how you then diversify each individual part of your portfolio. So there's a lot more going on under the water than people realise when it says, well, what's my asset allocation? How do I control it? There are a number of levers that somebody like me has to be able to control the speed of the car, to keep that analogy going. But if the speed limit's 100 and you drive between 90 and 110, you're generally going to be okay. From a risk perspective, if you drive 160 in a 100 zone, unless you're married to the policeman that pulled you over, you're probably not getting off a ticket. But in the same way, if you did 40 kilometres an hour in a 100 zone, what would happen? You'd annoy everyone behind you, you'd probably get beeped at, and you'd be late getting where you're going. So for me, I'd say that example there, doing 40 in a 100 zone, is being too defensive, too risk averse, too much cash, too much fixed interest. That's just as dangerous for me as doing 160 in a 100 zone, because you're missing out on market opportunities and an ability to have enough assets in your portfolio to grow and offset inflation. Because people come in and say, oh, look, I'm getting older. I need to be more conservative. And I go, really? Oh, you don't like income? Yes, I'd like some income. And you don't like growth? I'd like some growth too, please. So what does being older have to do with it? I'd challenge that methodology that you need the same risk profile in retirement as you did while you were working. And that generally washes out to 70-30, 60-40. I think anything under that, you're giving up too much in the way of growth opportunities to offset inflation.
When we talk about how much risk we carry in our super fund, I guess people's perception might be coloured by the notion that shares are very, very risky. And we know that our super funds invest quite a lot in shares.
Yes.
So that's an assumption that people are making.
Look, great one. So let's come back to the conversation I had today. Oh, self-managed super funds risky. Okay, so here's the way I will explain that. Commonwealth Bank shares in my name, your name, joint names, family trust, industry fund, personal super fund, and a self-managed super fund, the level of risk you're carrying is exactly the same. So again, we separate what are the assets, what's the structure. I'd argue you've got more control in a self-managed super fund to mitigate risk than you would in other vehicles. But we need to make sure that we understand what sort of Australian share are we buying. We buy Wesfarmers, okay, Bunnings isn't going out of business anytime soon. That's very different to a diamond mine in Uganda. Now, they're both Australian shares. So again, that assumption that they're risky, it's like saying, well, two cars of different colours have different levels of risk. No, they don't. It's how fast you drive them. And that's where we need to get to a more granular level and understand what you buy in your super fund as to the true risk that you carry, because generalisations can be very misleading.
They can indeed. Luke Smith from Envision Financial is with me in the studio today. We're asking the question, how much risk do I actually carry in my super fund? It's about 11 minutes to 5. We'll be back with more in just a moment. Seven minutes to 5 now, and Luke Smith from Envision Financial is with me in the studio today. We're talking about how much risk am I actually carrying in my super fund, and I'm kind of curious now. What are the key things that people need to remember when you're trying to work out what risk profile is actually most appropriate for your own circumstances?
So, first one would be don't associate super with risk. Risk is driven by the investments in the vehicle. Super is not risky. Super funds are just vehicles to hold assets that are very, very tax effective, and you should use them to the utmost. Understand what you're holding. Look at the pie chart of your super fund, and if you've got more than 70 to 80% in growth assets, which we said before the ad break is Australian shares, international property and infrastructure, if you've got more than 70, 75% in that allocation, you are not a balanced investor. You need to understand that in good times it'll be good, and in bad times you are going to get belted. Now, if that keeps you up at night, maybe slow it down, because there'll be other options that you can choose, or mix the options. I had a lady in this week who said, I've got the balanced option and I've got this particular investment in an industry fund. And when I broke out what she was holding, she was running 60% in international assets, which is like drunken rhino stuff. Like, there's no need to be doing that. And she had no idea. She said, I'm just a balanced investor, whatever that means. So interrogate what you're holding, because while things are up and everybody's, buoyant, very exciting. You have a COVID-like environment and you're holding a very high allocation to growth, you're going to get whacked, okay? So understand what you've got. Generate income from assets and maximise franking credits. Hold a year to 18 months of living money in your pension account, in the physical bank account of your super fund, so that 18 months of living money is not at market risk. It is free and clear, and you can live the way you want to live. Because I find people's attitude to spending changes when there's an emotional connection to a fall in value. We can't afford that trip now. Yes, you can, because you're not going to spend all your money in the next 12 months and it will come back. So if you keep that 12 to 18 months of living money in cash, it shouldn't deter you from doing what you want to do, because after all, you've spent 40, 50 years getting this money, and now you're at an age where you can use it. Use it, right? I'm pro-spend to a point, but I find the peace of mind of having a holiday and not regretting it. You don't go on holiday to regret it or feel bad about it or change what you do on the holiday. So if you've got that 12 to 18 months in living money, and that would include potentially a holiday you're going to have next year, great, put it in cash, take it out of risk, let everything else grow and do what it's going to do. But understand how you're breaking down the assets in your super fund understand the risks that you're taking on, diversify with multiple investments in particular sectors, and get into a super fund that lets you control franking credits, dividends, and is taxed at a member level so that you can make the most of the things that you've accrued in super. I think if you can manage that risk and understand that it's what you hold, not how you hold it, I think some education and some peace of mind goes a long way to maximising how you perceive your retirement and the way that you live.
Yes, it's the difference between that diamond mine in Uganda that you mentioned and some of Australia's blue chip shares like
Correct.
the CBA that you mentioned multiple times. So, Luke, where can listeners get more information?
Yeah, so office number 6260-4749. We've got envisionfinancial.com.au on the internet. We've got the podcast, The Strategy Stacker, Luke Talks Money on iTunes and Spotify. We've just had the backlog on Spotify caught up because we had a glitch there and we'd lost a lot of the history, but it's all back. And we've got Smart Money Strategy, your ultimate guide to financial planning, in all good and bad bookstores, with entire chapters on asset allocation and how to use income and franking credits in retirement.
Not only in the bookstores, but also available online.
Yes, it is.
There we go. Luke Smith, thanks very much, and we'll catch you again next Friday.
See you next week, mate.
Luke Smith from Envision Financial back again with us in the studio here at Radio 2CC at the same time next Friday afternoon once again.